So, welcome. I'm glad to have you joining our program today. We are going to be talking about money, but we're going to begin with talking about Adam's financial concepts. I don't talk about this very often, but I will today. And the future of Adam's financial concepts, and I want to introduce you to one of our new advisors, or not so new advisor, but he has been with us, and you want to hear what he has to say. It is the future of Adam's financial concepts, and we're making changes in how we work and changes which I think are beneficial to our clients. Maybe that's a listener out there as well. We've been working remotely since last March. That, I believe, will change in the next couple of months, and we'll be going back to a regular time. I've been in the business now for 36 years. I've been managing client portfolios, and I actually post client returns. We've been beating the Standard & Poor's 500 total return with the dividends reinvested. We've been doing that now for all the time I've been at Adams Financial, since forming it 16 years ago. Not every year, but from year to year. We do, on an average year, beat the Standard & Poor's by almost 4% per year. That makes a significant difference. I'm one of the very few, we're one of the very few companies that post our returns, and it's a composite of how our clients are doing. It's not a model, it's not back tested. It's actual client returns, net of all fees, net of all costs, net of all expenses. It's actually what the clients are seeing in their accounts. We've hired Morningstar to collect the data from our custodian Interactive Brokers. They collect that data. They collect it on a daily basis. They collect the information on the changes in the prices of securities that are held in client accounts. They collect the information on what's added, what's taken out, and at the end of the quarter, they calculate for each and every client a portfolio return, and they compile that. That's all compiled into a composite, and we publish that. Now, the profit sharing accounts, we're actually doing a performance report every month, but the growth counts, those we're doing on a quarterly basis, and those we have going back all the way to the beginning of starting Adams Financial Concepts. And we're one of the very few, very, very few, who actually publish our results. You can go look at them. You can look at them on our website, or if you sign up for a newsletter, we send them out in our newsletter. And what we want to do is not just manage portfolios, but we're looking to use that. It's not just in terms of managing investments. That has an impact on people's lives. We're looking to enhance the returns, and there's a reason for that, because we want to provide for a margin of safety. We've just gone through a pandemic, or we're just coming out of the pandemic. We could be going into other black swans or black elephants. These are the unexpected events, or the expected events that no one really wants to talk about or prepare for. Went through the Great Recession. We went through the dot-com bust. We went through, these events are happening more and more often, and will probably continue to happen more and more often. So we're looking forward. We want to build a margin of safety so our clients have that comfort as they move forward in their lifetime. We want to build, for many of our clients, to meet their concerns about providing for their heirs. And many of our clients want to make a difference in the world and in the community. That's the benefit of what we do. We're providing for that in most cases. And I've been doing this for 36 years, but it's not been something I know that I can continue to do for the next 36 years. So Adams Financial Concepts has actually grown this year, and we have 2 full-time advisors in addition to myself, and a third who is studying for her test and maybe coming along. And I'm going to introduce you to one of those advisors later in the program. But I want to shift shift right now and talk about Peter Lynch. Peter Lynch ran the Magellan Fund from 1977 to 1990, 13 years. And some of the people who are listening may not recognize the name or know who Peter Lynch is. He's one of the great investors. During those 13 years, he averaged 29% per year on an average. Not every year. There were times in which the Magellan Fund would fall off and plunge down. There were times when it did much better than 29%. But if you look at those 13 years, the average return was 29%. Had you invested at the beginning, had you invested $500,000 at the beginning of those 13 years, at the end of those 13 years, that $500,000 would have grown to $13 million. Think about that. $500,000 would have grown to $13 million. That's a very nice return, right? There's very, very few people who have been able to duplicate that. You can count them on one hand who have been able to do that in that period of time. And that's why he's considered one of the great ones. He's written a couple books, One Up on Wall Street and several others. And I use this quote very often, that he said that I'm always fully invested. It's a great feeling to be caught with your pants up. It's not like trying to time the market and selling when the market suddenly surges upward or buying when the market suddenly surges downward. Peter Lynch was invested the full time. He rode the ups and downs. Nothing was going to scare him out of the market. There were going to be setbacks. There were going to be times in which there was almost a calamitous drop, you would think. And he recognized that. He said that time and again. And during that period of time, 29%, 500,000 to 13 million. But you know what? You would have thought that most people would have made a lot of money, but Fidelity did a study. Fidelity was whom he worked for. Fidelity, the Magellan Fund is part of the Fidelity family of mutual funds. And Fidelity did a study, and they found that the average investor in the Magellan Fund lost money. So how did that happen? I mentioned this last weekend to a client of mine. We had breakfast, and we were talking, and he said he understood that. He understood that because he was an investor in the Magellan Fund, and he lost money in the Magellan Fund. And I squinted my eyes, and my brow knitted up, and he understood. He said, you know, whenever the fund went down, he sold. When it would go down, he got scared, and he sold off. And then, when it was up and everybody was cheering and talking about it again, he bought back in. Only a year later or 2 years later to sell out again when the fund was going down. And in that period of time, in those 13 years, he lost money. And he said it's almost a natural feeling because it's really scary when investments go down. You remember, March of last year, March of 2020, when the market went down, it looked like it was going to continue down. Even I was worried at that time. I sat down and thought, do I sell out completely? That's the first time in my career I really thought about selling out. The very first time. Rode through 2007, 2008, 2009, rode through the dot-com time, rode through 1987, rode through all those times. But in 2020, with a new pandemic coming, I really thought about selling out. But once the government began to fund and pump money into the economy, to stimulate the economy, I felt really good about it. So that's where I was at that time. That's what I did. That's Peter Lynch. Fear is natural, but it becomes our worst enemy in investing. Being emotional, getting excited when things are up, and being pessimistic when things are down. It should be just the opposite. It should be being greedy when everyone else is fearful, and being fearful when everyone else is greedy. That's the Warren Buffett quote, and that makes sense. It makes sense in terms of that old saying, buy low, sell high. And that's what it's all about. That's what it should be about. There's very few times that I talk about that, and we're going to come back after the commercial break and we're going to talk more, because these are one of the times at Adams Financial Concepts when we are underperforming the market. And I think it's a great time to get involved. It's one of those times in which we're not plunging down like we did in March 2020 or like we did in 2007, but it is one of those times in which we're trailing the market right now by a little less than 10%. But I believe, my opinion is, we're going to see a catch-up period when we outperform the market, when we pass the market again in its performance. And so I think it's an opportune time to be in the market. Don't go away. I want to return and talk to you, and you want to hear and see the introduction to Souza, who's coming up in the next segment. Don't go away. We'll be right back after this commercial break. So, welcome back. I've been talking about Adams Financial Concepts. I don't talk about us very often in the program. I don't spend a lot of time, mention it a few times, but today I want to talk about it because it's important to talk about, and there's an opportunity for investment right now. One of the best opportunities I've seen. I started talking about fear. Started talking about Peter Lynch and Peter Lynch ran Magellan for 13 years, from 1977 to 1990, average return of 29%, and yet the Fidelity study showed that the average investor in Magellan fund lost money. And fear is natural. I mentioned 1987. 1987 was a time in which the market plunged over 30% in one day. In one day, there was a lot of fear. It was like the financial world was coming to an end, and people began to talk about the financial world coming to an end. And I was new in the business at that time. I licensed in June of 86. Now here it was, October of 87. I've been just a little over a year. And I began to count the number of people who were negative about the market, who predicted much worse ahead. I began to count them on TV, the people on TV. That was before CBNC, but still news commentators. There was the Wall Street Journal, there was the Investor Business Daily, there was the Money Magazine, there was Fortune, there was Forbes, there were a lot of magazines, there were articles in the Seattle Times and the Seattle PI. There were articles all across a group of people, and I began to count how many people were negative and how many people were positive. And within a couple of weeks, I quit counting because the score was 68-0. 68 people were negative. I could not find a single article, a single person who said things were going to get better. It's what I call a white knuckle time, when you're riding in the market and you're hanging onto the chair and your knuckles are getting white. And even as the market began to recover, and even as I looked at the charts and looked back to 1961 and the day of Pigs invasion, when you had a similar drop and recovery, I think I was the only positive person around in a sea of negatives. And as the market began to recover, people began to talk about seeing the light at the end of the tunnel and worrying that the light at the end of the tunnel was a train coming towards you. That fear is natural, but it's our worst enemy. R.W. Baird did a study a few years ago in which they looked at over 14,000 mutual funds. And they looked at those funds which over a 10-year time period, had an average annual return 1% in excess of their benchmark. Out of those 14,000, there were 370 mutual funds that actually outperformed their benchmark by at least an average of 1%. But during those 10 years, 100% of those funds underperformed at least 1 year. 85% underperformed for 3 years. And 25% underperformed by more than 5% over 3 years, and 25% underperformed by at least 15% or more in 1 year. So you put yourself in the case of an investor in those funds during that period of time, when you're down 5 or 10 or 15% or even more. Do you sell out and move on? You know, we had a return of 77% in 2020 versus the Standard & Poor's 16. We were up 40% in 2019 versus the Standard & Poor's at 31%. We were up 21.5% for the previous 12 years versus 16%, or 16.5% for the Standard & Poor's. That's our track record. But if you look at it in more depth, you'll see that in 2016, we were minus 3.3 versus the Standard & Poor's, which was up 17. We underperformed by 20% in 2016. In 2014, we were 11% versus 13. We underperformed by 2%. In 2013, we were 15.5 versus 16, underperformed by 0.5%. Not bad for a 12-year track record in which our average return was 21.5 and the Standard & Poor's was 16. And so far in 2021, we're plus 3.3% versus 12.5 for the Standard & Poor's. And there's no assurance that what has happened in the past will happen in the future. But it seems that every time in the past when we've underperformed the following year, or 2 years, or 3 years, we significantly overperform. So if we're down this year, it just seems to me, in my opinion, that it's a great time to really get invested, to take advantage, if we're really right. And we do think that we're right. We think that we are at a Pearl Harbor moment right now. Coming out of COVID, it's a Pearl Harbor moment. You know, when you think back to World War II, as World War II came to an end, the GIs were returning, home building exploded. Small homes, I grew up in an 850 square foot home, but there were homes being built for all the GIs. Education, they were going back to school. The interstate highway system was built at that time. There was a car in every garage, and most garages were one-car garages. And there was a shift of transportation from taking the bus to air travel, building airports. Lifestyles changed. TVs replaced radio. The telephone became a real instrument of communication. I grew up in my house. We had, when I was going to grade school, we had a phone number that was 3 digits long. In fact, you could call the operator, and when I was a little kid, I couldn't remember the numbers. I just had to call the operator and say, I want to talk to the Johnsons or whoever, and the operator knew who they were. She would just plug in the wires and connect us. That changed. It was automated, and switchboards came into being. We saw at that time, as the GIs returned, people buying washing machines and dryers for the first time. The banks gave out toasters if you open an account, a toaster with a timer. The old toasters used to pop the bread in, and you have to remember to open the toaster up or you burned everything. Banks began to give away a toaster with a timer so that the element would shut off and not burn. And we began to live longer. We believe that we're coming to a dramatic time of change right now. We believe things are going to change. If you look at just the energy sector of the economy, it's the biggest industry in the world, $10 trillion. If you look at the media industry, we're on the radio right now. If you look at radio and TV and movies and papers and magazines and the cable and everything in media is a $1 trillion per year industry. Energy is $10 trillion. And there's going to be significant changes taking place. We want to be ahead of the curve instead of behind the curve. Global energy demand is going to continue to grow and will be driven by emerging nations, in fact. And while energy will continue to grow, fossil fuels will decline as renewable energy comes on board. And there'll be a transition to lower carbon energy with greater consumer choices and restructuring. oil demand is going to decrease for the next 30 or 40 years as a function of increasing efficiency and electrification of road transportation. We're going to see electric vehicles. In my opinion, the internal combustion engine in 30 years is probably going to be a special order. Natural gas will be more resilient than oil, but it too, because it gives off methane, natural gas will eventually be replaced as well. Renewable energy will, over the next 30 years, with solar, with wind, with geothermal, with other types of energy, they're going to come. And in fact, there are experiments being done to generate electricity from other areas. And we haven't even begun to talk about claiming energy from dark energy and dark matter. We're going to use hydrogen, will increase in the energy. We're going to see bioenergy coming along. The world is on a path of complete change, and there's going to be tremendous opportunities. They're going to be coming out of technology, and it's going to change our lifestyles. It's going to change our longevity. It's going to change the way we live. It's going to change our demographics. Which brings me to the point of Adam's financial concepts, returning back to that. Returning back to that because I want to introduce you to my guest, and we're going to come to him right after this commercial break. I just want to leave you with one other thought. As the oil industry changes, it's going to have a dramatic impact on countries. If you just think about Russia, 50% of their governmental revenues come from oil. When the price of oil dropped, the ruble devalued. In 2012, at $100 a barrel, you had 27 rubles to the dollar. In 2014, with prices dropping to $60, 53 rubles. And in 2018, as prices dropped to $40 and lower, 82 rubles to the dollar now. That puts a huge amount of pressure on those nations because while the number of rubles remains the same, when they have to buy something outside the country in dollars or in Chinese yuan or other currencies, it's more expensive. It puts tremendous pressure. And those are Russia I take because they have a high influence in the world. There's a huge pressure. But if you look at countries like Saudi Arabia, Iraq, Iran, Nigeria, Brazil, and 30 or more nations, there's a changing aspect going on. We believe there's advantages to be taken as we go forward. And we're going to talk more about those as time goes on, as this program goes on. And we're just talking about energy. There's going to be changes in robotics. There's going to be changes in bioengineering. That's all important. But stay with me. I'll be back right after this commercial break, and I'll introduce you to Al Souza. We'll be right back. So welcome back. I want to introduce you to Al Souza, who has joined Adam's Financial Concepts. And if you're not a client of ours now, you should be talking to Al. He's going to be around for a number of years. He's going to be one of the best financial advisors in the industry. That I believe very, very strongly. So let me turn it over to Al. Al, tell us about your background.
How you doing?
Good.
Well, I grew up in a family business. I was in the hair business. My family owned a bunch of barbershops around the Boston area. And I did that since I was about 13 years old. The irony in that is that the only thing that I think Jeff Bezos and I have in common is our hairline. So bald as a cue ball, but that's what I did for many years. So, and then I transitioned out of that about 14 years ago into I started out selling health insurance and life insurance, and moved into doing investments for people.
So tell us more about you, your family. You're now in the Gen X generation.
I am.
The Generation
Yep.
X.
Yep.
And that's
call it
the changing demographic.
Mm-hmm.
So talk about what's going on.
Do you have a question there?
Yeah, tell us about what's going on in the Gen X. You know, it's a time in which many people have children that are leaving the house. They're growing up. They're going off to college or getting jobs. That's a time in which, you know, they're experiencing empty nesters. They're also getting close to retirement and thinking about retirement. And some people have already retired. It's a change in demographics. And so tell us more about what's going on in your demographic.
Well, I mean, I'm in that situation, right? They call us a sandwich generation. I got aging parents. My dad's 84. My in-laws are in their 80s. I got a kid going off to college next year, right? I'm 50 years old, and you know, potentially I should retire in 15 years, but that's not my plan. And I was just looking up. I did some looking at Generation X and what they think, and it tends to be that Generation X people are very pessimistic. They don't think they're going to be able to retire as a group. It's really interesting.
So, what about the person that doesn't think that they're going to be able to retire? How can you help them?
I think, you know, as I sat with a client yesterday that they were in the same situation. They were a little bit older, but potential client yesterday, and they had some debt issues and things like that. And just by talking to them and restructuring a few things, we were able to look at ways that they could move things around and actually get the income they needed to retire. And they left the meeting more optimistic. They had a few homework items they needed to do, but I think if they accomplished them just without even having to try to get extraneous returns in the market or having to go back to work, I think they're going to be okay. So there are things that people can do if they just sit down and look at just putting some sort of plan together and talking to someone like myself and saying, hey, what can we do to enhance our probability of getting to retirement and having the income we need? And, with the strategies we use, we can obviously enhance their income, so we can help get them there.
And a lot of times we're seeing people in the wrong investments, right?
Yeah, yes. We see people that most people that I seem to talk to don't really have a clue of what their investments are doing, don't understand the cost and structure or why they have the investments. And so when we can explain that to them, we can explain that, that what they have, and ask them why they're in it, and they figure out they don't know why they're in it, then we can restructure things and put them in a lot better situation going forward. And that's what I've been seeing. And
you mentioned that you'd talked to somebody that had a municipal bond fund who had an income of $100,000 or so. Tell us more about that.
Yes. Yeah. He thought he was invested. He said his advisor had passed away and they moved it on to the new guy, and he thought the guy was doing a great job. I said, okay, well, let's look at the statement, just take a look at it. And he's about 66 years old, and he wasn't a high income earner. And we looked at all his funds, and he had income. They were all income funds, and one of them was a municipal bond fund. Well, it's completely inappropriate because he didn't have a tax problem, an income tax problem. So there's no point in being in a municipal bond fund and something that's going to produce I think it was producing maybe a 2% return on him. So it didn't make any sense for him. And he had this impression that he was getting these great returns, and he really wasn't. So.
And a lot of people we talk to, that I talk to, that you talk to, think that their returns are really good when you sit down and evaluate. What they think is maybe a 10 or 15% return turns out to be more like 5%. And that just eats away when you add inflation of 2 or 3%. That does not leave very much accumulation of capital, right?
No, it doesn't. No. I mean, It doesn't at all. So, I mean, we try to sit down and break these accounts down and see actually what people are paying for and what they're getting. You know, the question I love to ask people is, do you think you're being paid for the risk you're taking? They have no idea. So they have no idea what their risk tolerance is, a lot of them, and they have no idea what they're invested in and how that's going to affect them long term. So it's an eye-opening conversation to sit down and be able to explain to someone that, actually the returns aren't what they thought they were.
So for someone that comes to you that wants a second opinion, how do you go about doing that?
Well, the best way to do it is if I can get copies of your accounts. If I can see what's in there, we can, look at the mutual funds and then run an analysis to see what the actual cost of the mutual funds are, and then that's the best way that I can tell what the cost is, and then find out what the advisor's fees are charging, and we go from there.
So, when you think about it, the biggest worry of all ages, not just in the Gen X age, 88% of all people are concerned about running out of money. And most financial plans don't work. They didn't work because they never anticipated the pandemic. They didn't anticipate the Great Recession. They didn't anticipate the .com. So sitting down makes sense, right?
Say again, I missed the last part of that.
Yeah, sitting down and going through a complete analysis and seeing where people stand, that's part of what really makes a plan work.
Yeah, absolutely. Absolutely. Yes. I mean, just the Generation X is a study by Northwest Mutual, 1 in 5 feel pessimistic about retirement. 39%, this is a TD Ameritrade, 39% feel they'll never have, a financial source of financial life to retire. So, I mean, but there's things they can do. If they take an active approach, they can hopefully, produce better returns and get to where they want to get to. So,
tell us your email address while we're talking, so people can contact you, and your phone number.
Souza at adamsfinancialconcepts.com, and my phone number is 206-858-3885.
So say that email address for somebody that didn't pick it up again.
It's Souza, that's ASOUZA, at adamsfinancialconcepts.com, and my phone number is 206-858-3885. And
if they do get a second opinion, is there any cost to doing that? Is there any?
No, there's no cost to getting a second opinion. No. We can sit down and quickly, in 10 minutes, get it running a Morningstar analysis and tell you what your cost and what your actual returns are, and see how you want to proceed from there. I did that yesterday with a client, and so I'm happy to do that.
So I strongly, strongly recommend for listeners that are listening to this program that you do contact Al. Call 206-858-3885, or, as he repeated his email address, Souza, ASOUZA, at Adams Financial Concepts. He is well respected and very, very knowledgeable. And it's a second opinion. There's no cost. There's no obligation. And yet you might be very, very surprised to see what the results are. So, Al, thanks for being on the program. Thanks. And
thank you, Mike.
For being part of Adams Financial Concepts.
Absolutely. It's my pleasure. It's a privilege.
So we'll be coming right back after this program. I want to talk about my favorite movie and why it has application to the investment side. So, and again, Adams Financial Concepts is growing. You just heard Al Souza. He is really going to be one of the stars in the industry. So contact them when you have a chance. And we'll be right back after this commercial break. So welcome back. I want to talk about my favorite movie of all time because it does apply to my industry. It may not seem that way, but it truly, truly does. And that's one of the reasons why I like this movie. It's called The Sting, 1978. Paul Newman and Robert Redford. It has twists and turns. It's about the confidence game, the con. But it has specific rules for how it goes about it. And I think when we talk about this a little bit, you'll understand why I say it applies to my industry. Because step one is called the put up. The idea is to identify the mark, the most important aspect of the whole thing, figuring out what they want without them realizing, and then playing it back to them, talking to them in terms of the other person's interest, because familiarity brings affection. You know, the idea for the financial firms, for the big firms that I worked at, was to sell the relationship, not the performance. Same thing. You want to feed back to the client what they want to hear. You want to feed back to the prospect what they want to hear. It's identifying the mark. Same thing as in the Sting. It was the put up. And step two is called the play. It's the emotional appeal, thinking reflexively rather than rationally. It's the brochure that shows the couple sitting by water. It could be the ocean, it could be a lake, or on the golf course playing golf. It's an emotional appeal. It says 1,000 words without saying a single word. It says, this is what your retirement looks like. You just heard Al Souza talk, and we've talked about 88% of the people do not think they're going to have enough money to retire. And yet the brochure, the play, shows the people sitting by water or on the golf course as if everything is okay. That's the play. That's the emotional aspect, to connect with people emotionally. That's the whole idea in this industry, is to make you think it's going to be okay, when in fact, the reality is for most people who are retired, they're sitting around the kitchen table trying to figure out how they're going to pay bills. And if you're not in that situation, if you're on the golf course, if you're by the lake, how do you know it's going to stay that way? You should talk to Al. That's what I'm saying. The step three is called the rope. There's 6 pervasive principles: reciprocity, consistency, social validation. They try to validate you socially. They try to build a friendship. They try to build the idea of scarcity and authority. They are the authorities, or so you think. Now, that's been called into question any number of times, but they will try to tell you they're the authority. They'll take all your information, plug it into a computer, and the computer will spit out a report, and they become the authority. No, the computer is the real authority. The computer generated those numbers, not the advisor. And the advisor will plug you into investments which may or may not be very, very worthy of what you should be in. That's called the rope, building that relationship rather than the performance. And then step 4 is called the tail, where they try to make you feel special. That's the relationship. You can see this whole idea of selling the relationship and not the performance. It's the tail. People think they're special, and they want to think they're luckier. You want to think you're lucky to be working with this person. Now, there's some people who you are luckier to work with. I think that's at Adam's Financial Concepts with Al, or with me, or with Chris, or Jen soon. And clients tend to justify their decisions. I can't tell you how many times I've talked to people who justified where they are, even though they know after it's pointed out, they know that their returns are terrible. They know that they're not any closer to being able to retire than they were prior to our discussion, but they want to convince themselves and rationalizing the fact. And then step 5 is called the convincer. It's the payoff. It's the payoff from the Ponzi scheme. It's convincing the market, convincing the client that they've won, convincing you that you're going to have enough money. It's the financial plan. It's the plan that shows if you put this amount of money away, you're going to have enough money. The only problem with that is financial plans didn't work for the pandemic. They didn't work for the Great Recession. They didn't work for .com. When you have an upset, they just don't work because that's not built into the program. The financial plans are built around the idea that everything's normal, everything's going to be static. The average stock return is going to be the average bond return is going to be the average commodity return is going to be the average, inflation is going to be an average. No, not true. But that's the convincer. That's convincing them that you win and you'll make it. And then for the con game comes the breakdown. That is where people realize that they've lost. For a financial plan, that comes when you're about to retire and realize you don't have enough money to retire. And that happened. It happened in the Great Recession. For some, it happened during the pandemic. Not many, because the pandemic ended very quickly. However, if we go back and look at the time period, 1961 to 1979, the impact of inflation, it took 32 years for the stock market to recover purchasing-wise, dollar value purchasing-wise. So what a dollar would buy in 1961, with inflation from 1961 to 1992, inflation increased sixfold. So what that meant is stocks had to increase sixfold from 1961 to 1992. And it took that amount of time for that to happen. That's the breakdown. That's when it doesn't work. But by that time, it's too late. My industry depends on building the relationship and not the performance. We believe that the real point is to build the performance. We build a margin of safety. We want to build a quality of life. If you look at somebody like Jeff Bezos, who was mentioned earlier in the program, if he lost 90% of his net worth, it probably wouldn't affect his lifestyle at all. We have clients that if they lose 20% or 10% of their net worth, it will impact their lifestyle. So we're very focused on making sure that people get the performance they need, that they get the margin of safety they need, that it becomes a quality of life performance issue, and that becomes the focus of where we are. That's what we want for our clients. That's what we want for everyone, even for our non-clients, is to be sure that they're going to have a quality of life that will pass through a pandemic, that will pass through a Great Recession, that will pass through a time of high inflation, that will pass through any of the other upsets and things, because things that have never happened before will happen all the time. We just want our clients to be prepared for that. Anyway, thanks for being with me all day today. I've talked about Adam's financial concepts the whole day. I don't do that very often, but I did want to do it and introduce you to Souza. Call him. Or send an email, Souza, ASOUZA @adamsfinancialconcepts.com, or call him 206-858-3885. You'll be glad you did. I can tell you that. And thanks for being with me. Have a very good rest of the weekend and a very good week. And I will be back next Saturday to talk about money. Have a great week.